Hey guys, my name is Ruben. In this video, I'm going to go over my supply and demand trading strategy. As you guys may or may not know, I've been trading supply and demand for roughly 6 or 7 years, and I've been studying and looking into the markets for a little over 10 years. I have taken stocks, futures, forex, options. Last year, my options did in 2019 about a 400% return. And during these past few weeks, my futures, I have made roughly around $3,000 using no more than 3 micros during this coronavirus pandemic since about the middle of March or so. And so I want to talk about how I use supply and demand and overall the trading strategies that I usually use. And it's usually a lot more intuitive than what you guys might be used to looking at a lot of the asset classes. And although I do love looking at all 60 plus asset classes, I think it's safe to say that most people will not be taking all 60 supply and demand zones, right? And so that's why I really started to develop a lot of my trading strategy and started to hone in on these methods and these things. And it's really, in my opinion, a lot easier and much more intuitive because I really don't look at the markets any different than I look at the way I buy or sell anything else. And I know that you guys hear that all the time. But what I mean by that is my favorite thing about the markets is that they are the most liquid thing in the world. If you buy real estate, if you buy other things that are also investments, they're not as liquid, so it can be more difficult to unload them. So for me, my favorite thing about trading and investing has always been the fact that you have the lowest barrier to entry, being able to open an account for Forex, for example, for as little as $200. And then obviously with stocks, you can day trade them more than 4 round trips in the US with over 25K, and then options gives you a different set of leverage. But my favorite thing about all of this is that when it comes to supply and demand, it's really, really universal. And because I always realized that I couldn't look at 60 markets at once, I had from the get go decided that I would always take the best risk rewards. That is just the kind of person I am. And so the way I look at the markets, and when I say that I look at them the way I look at anything else, and the reason I related them to my favoritism towards the markets and supply and demand and liquidity and barrier to entry is because the only thing for me that makes the markets different from buying and selling and investing in anything else is the fact that you can see the historical price. You can see, contextually speaking, where the price of a stock, options, futures, forex, whatever, has been over an extended period of time. In real estate, for example, you do not have the luxury of looking at the historical price of a house per se or commercial property in a given zip code during a historical period of time in the same facility or in the same with the same ease that you can look at a stock, future, or option. So with that said, I my first rule for getting into the markets, any market, is that price is king. So even before I look at supply and demand, I ask myself if everything went south, if the apocalypse was indeed coming, would I be okay at buying any one stock, futures, forex, or option at this price if everything goes down? And if that is the case, then how much of it am I willing to buy? And looking at the chart for the historical context to give me of how much of it. From there, I look at the best supply and demand and the best price criteria that I feel would give me such reward. For example, here is a chart of Royal Dutch Shell. And so I was looking at Shell, I was looking at Exxon. So Shell is 36.55 is what it closed at. And I'm going to go ahead and use simulated trading because it is after market hours. I usually dedicate most of my market time looking at the markets because I generally love them. Although I do believe you can set and forget them and usually trade with alarms. Nothing I say is a buy, sell, or hold recommendation. You can lose all of your money in any given market. Your returns may not look like mine, and I will never suggest or imply that they should, but I do believe that it is much better to teach someone how to fish than just feeding them. So my goal is that through my education and trading and investing videos, that you learn the markets in a very intuitive way, which is what I eventually got to. And the markets then just became an extension of myself. And so eventually you won't need me, right? And that's ultimately the goal. So with that said, looking at Royal Dutch Shell, it is $36. Looking at Exxon, it's $46. So depending on your starting capital and your goals, they follow just about the same correlation, right, to the price of crude oil and WTI, for example. So then the reason I go into explaining this is because there's a couple of ways you can approach this. I always usually tend to go first with looking at the biggest percentage move. And the reason I said I am on simulator right now is because I am about to then go back into the week when the market was open on Thinkorswim and then go over my logic and thought process. But the first thing I'll say is that I look at all the markets simultaneously and all the asset classes simultaneously, and then I look for the biggest percentage move in my favorite asset classes. I primarily trade the NASDAQ and the tech sector. So Apple, NQ, Nvidia, because I'd rather be a master of something that I have always found to be an extension of myself, and that's just my personality, than to be looking at all of these markets. But right now, I really love the price of crude oil, generally speaking. So then the first thing I'm going to do is I have my watch list, and I am going to go ahead and arrange them by the biggest percentage move. So the first thing I'm going to do with my watch list is customize it and add percentage move, because to me, that's the first place I'm going to look for the best opportunities and chances. So as I add that, I will now arrange them as such. And that is the first place I'm going to go to and start looking at supply and demand. And that includes all the stocks, futures, and I will do the same thing for Forex. The great thing about Forex is that you do have a heat map. So your eye can easily be guided to where the best opportunities might be. For Forex, I do use quarters theory, full disclosure. So those of you that know David Warner or that know me and my Forex that I've done live videos on know that that quarters. I love supply and demand. Samsung is one of my best friends, but when it comes to Forex, as David Warner said, I think yesterday, it is designed to facilitate price and trade. And so when you look at Forex, you look at it, you cannot divide a penny in half, right? So you're looking at it moving from quarter to quarter, and a dollar will be a dollar, 125, 150 per se, looking at the penny, which if you think about the way that leverage works in Forex, it's really just based on the decimal point, the pip. So you're trading fractions of a penny, and sometimes it is easy for us to get lost and tunnel vision in a specific chart or our position in such that we lose track of the fact that we're looking at a very, very small incremental price movements of a currency, usually when we're trading Forex, especially depending on the period in which you are trading. So I think it's important to remember that we cannot split a penny in half, and that is ultimately what we are trading. And to keep that in mind, and with that in mind, remember that, even if psychologically speaking, people are more inclined to buy a burger for $1.99 than they are for $2, you still cannot split the penny in half. And that is ultimately, more often than not, what we tend to be trading when you think about the Forex and the way the leverage is applied onto the Forex market. So with that said, I am going to go ahead and adjust the to sort everything based on percentage move. So I will get rid of the ask. I will get rid of the bid. I don't find the net change extremely relevant, but I would rather keep it. And so with that, I'm going ahead and going to then look at this by the biggest net change. So as you can see, crude oil has been the biggest change here. So that is the first place that I am going to look, or CL here is the biggest percentage change with this. So that is going to be the first place that I'm going to look for a supply and demand area. With me having had said that my favorite thing to do is to look at the biggest percentage move, I oftentimes get into the best possible pricing in the context of a weekly chart or a monthly chart. Because, for example, last year, whenever I talked about yielding a 500 or so percent return based on my options positions that I had, in which I will post the receipts later, but again, I'm not saying that you could accomplish these results per se. I really only traded, from what I remember, 4 big flagship stocks. I traded Tesla. I got into it and was really leveraging and capitalizing from it at around 175, Nvidia at about 140, and I really just managed those trades as vertical puts during that time because my logic was no matter what happened, I was happy to own Tesla at 175 and take whatever risk is associated with that. Same with Nvidia. And then as it goes in my favor, then I manage the supply and demand areas as I've already captured such an enormous percent gain on the trade. Therefore, then my incremental moves, and therefore, in addition to that, my leverage, there is less pressure onto what I do and manage thereafter because I capture such a big move. With that said, earlier this year, the initial drawdown with the coronavirus for many people was quite substantial. A lot of people had a 30+% drawdown. I did suffer somewhat of a drawdown. I did not suffer what the average market is going through, but I'm quickly recovering from that in less than a couple of weeks. So I also wanted to put that out there. And that was regarding futures because I just decided that I really, really wanted to get into futures in the most aggressive market conditions because in my ideology, if you can make it there, you can make it anywhere. And I also love testing new things during different market conditions. So with that, I was actually hedging. I was going long 2 contract or long 3 contracts, short 1. And the reason why I did that instead of being just long 2 micros and just no short is because I also wanted to keep and capture whatever down move came because it helps the exponential gain of then the as it goes in my favor. I am usually long side bias because as I said in another video before and quoted the Motley Fool, if you miss the biggest 10 up move days during, I think it was 95 to 2005, you miss the 10 biggest up days, your effective return can be cut to more than half, whereas you're trying to short the market, it's pretty hard to call a short or how long and the velocity thereof, and then the way the market snaps back down. So that is why I tend to be alongside bias, and it's also like trying to call the trying to shorten the market is also like trying to call the ceiling of the price of the rent in LA and Los Angeles. It's really hard to predict, whereas to knowing where I'm willing to buy and control something at any given point in time is very easy for me to decide what that price is. If you go into Walmart and you really like a television for $1,000 and you're already deciding between buying it and not buying it, and then next thing you know it's $400, then you're gonna buy it at $400 because you're willing to buy it at $1,000. So then if 31 days from now, after you can no longer return it, it falls to $350, you're not going to be completely upset and mad at yourself for missing those $50, right? So that's also my logic in always getting to something when you are willing to control it, because then you'll never lose sleep at night, and then your only question becomes at what point or how much of it do you want to own it, if you want to flip it, what have you. So with that said, now that we're looking at the biggest percentage moves, it's clear that the best trade is going to likely be in oil if you are a long side bias. But I will go ahead and do the same thing for Forex just to be fair. And then I will remove the strength meter because I already have that in my heat map. So now that I've done that, I will go ahead and go by percentage change. And so then full disclosure, when it comes to the Forex trading, I really only trade USD pairs, as it's something that I got from David Warner. I don't know if he still does only trade USD pairs, but for me, I don't know what DKK is. And I just opened Sim for you guys right now because I never even show Sim, but I just wanted to be extra safe regarding compliance and everything going on with the FTC and all that. So out of the pairs that I do know, the first one I see is Great British Pound USD. So contextually speaking, looking at the CL chart, and I will also link these to match this, so this could all be in sync. So I'm gonna go ahead and click on this, and so then here is the low. Contextually speaking, the high is 76.90, 10.8 of, oh wow, it looks like last year. So, and then price came all the way down to 19.20. So I'm just gonna go ahead and draw that here. Then I ask myself, contextually speaking, and based on what's going on in the market, am I willing to own this? at 1927. I don't believe. Oh, I guess this is crude oil. Wow. Um, so with that, I will then look at then the next eligible pair here with the biggest percentage move, my long side bias, and look at Great British Pound USD. And contextually speaking, if I looked at the low and the high, and I look at the percent, which let me see if I can do that here. I know I cannot interact with brokers, but I don't want to look at Fibonacci. So it doesn't look like it, but 4.3 coming down to 4.0. I prefer the crude oil trade way better, right? So now that I decided that I do like crude oil, I'm going to go ahead and switch to where I can go back in time. And the reason I'm going to do that is because I'm going to look then at the possibility of just buying crude oil flat out, buying maybe options on crude oil, USO, and then Royal Dutch. And based on my account size and what I'm trying to accomplish, one of those will make much more sense than the other. And so with that said, I am going to go ahead and go to on demand, which I hope that I can do it from this. If not, then I'm gonna have to log out and do it from my live account and then do it that way. So a couple of things here. So if you guys are primarily futures traders, then you guys pretty much know your risk reward with crude oil is about $1,000 a dollar move. And you're obviously looking at a downtrend. I am not going over a ton of supply and demand in this specific video, only because I assume most of you guys already kind of know that. So if you guys want to look at supply and demand, I did do a video just now that is called finding unfilled orders, and that kind of goes over more supply and demand. But in this video, I'm going to talk about finding the best possible trade based on your goals. And I do have a video on building your trading plan and reverse engineering your goals, right? You eat an elephant one bite at a time, especially when you talk about compounding. If you want to make $100,000 a year, then you know that, you have 12 months. So then you know that if you want to make 100,000, you divide that by 12. And so, you have to make 8,300 a month. Then you divide that by approximately, 20 trading days. So then you know that your target per day would be $416, and then you allocate your risk and reward appropriately, or your trades appropriately, and what have you. So then you can kind of get some contextual idea of what you're trying to accomplish. If you're trying to retire with, you're 60 and you want to pay yourself $100,000 a year times 20 years, and you know that you want to make 2 million, and then you divide that by 20 years, and then you divide that by and that ends up being the same number. So you divide that by 12, you divide it by 5. So with that in mind, then you can kind of begin to outline kind of your trading plan and what it is you're trying to accomplish. So with that said, if you have a smaller account and you want to consider trading options, then the way I would usually do that is sometimes I will look for out of the money calls, especially in a move like this. And so with that, I'm just going to go ahead and go to the options chain for this. And so then we're going to look at a couple of things. If we know that crude oil is the best demand, then we're going to look at what can give us the best capture of that supply and demand range, right? So let's say that our goal here, so there's the 1 minute chart. So let me just link these two together. And let's say that our demand is, or our supply, let's say that our target, because again, especially because I am long side bias with a lot of these things, sometimes I would rather just hold and move my target, and then oftentimes use options for that. But again, that's for a different video. I don't trade with targets. I think I've said that before, only because, more expensive sometimes than the money lost can be the opportunity cost of the money not gained. And, with most of us know, I think that the index outperform, like the S&P 500 has outperformed 95% of money managers, or so I read, at least the last couple of years, historically speaking, for an extended period of time of 5 years. However, like I said before about the missed gains, or the money lost, uh, you know, missing the 10 biggest up moves can really affect you, and especially when you're talking about exponential growth and stuff like that. So that's why I would rather have rolling puts per se, depending on the asset class I'm trading or the stock, or manage them accordingly. Again, I trade supply and demand, pure supply and demand, but the way I stack and trade is very differently than how OTA or most other people teach it, because I'm always looking in that sense that I can say that I'm relatively greedy. I don't like to spread my attention a lot of different directions, and I like to load up. And in that way, I guess I'm more of a Ray Dalio type. I do look at correlations, but on top of supply and demand, I do tend to oftentimes look at the news and fundamentals and what have you. So I don't take targets for that very reason. I'd rather have, like I said, rolling puts or inverse correlations, or hedge it an account. So for example, if I'm long about $25,000 worth of Tesla, then I can look at a micro contract and kind of position that accordingly. If the market starts to go down at different zones of supply, then I can kind of just short then a contract so that I'm net neutral. And that's what I would prefer to do, especially in these market conditions and moving forward. So if you are looking to trade options and you have a smaller account, I might be looking at an out of the money call, because, and here's another reason why I look at this very different than OTA, because especially in these market conditions, if you're looking at in the money options, because there's so much fat or extrinsic value attached to out of the money or in the money options, especially when you're looking at more than 3 months. In a down move, you sometimes lose so much more than the stock. You can, because all of that extrinsic value just disappeared and the stock is going down. So it could become a double negative. So that's why I'm generally speaking, because I know supply and demand, I am not an in the money options trader. If something's in great demand, I would rather trade the at the money or slightly at the money call between supply and demand, because the logic is, if you're going to risk $100, you can, actually, it's a great example. So let's say that it's currently at 28.50, right? So if you wanted to risk $100 and you look at the futures contract, you might be looking at 10 cents, right? So you have very little room to be right, and you can only really do one contract. If you're looking at USO, then you can, so let's look at USO. And again, I don't love the way USO moves so much, and just USO in general, but for example purposes, I think it can be pretty relevant. If you wanted to risk $100, then you can buy 100 shares with a stop loss here at, $4.98. So, right, so now we're looking at the best risk reward options with the percentage move that we're looking to take, right? So then you can buy 100 shares with a $1 stop loss, and hope and pray that overnight nothing crazy happens. Or you can consider buying out of the money calls between supply and demand, or at the money, and your risk reward then will, if you want to risk $100. So let's look at the options chain. Again, this is theoretical. I am not a big crude oil trader, but this is what came up right now. So let's look at trade and looking at USO. So I'm going to go ahead and add a chart here because, well, I like context. So, oh, here it is. So I will obviously link it to the same thing. And I will make this a chart. And I will hack the platform and do 9 and then just drag them down. And I will remove level 2 and I will make them all red. And I will make them all charts and get rid of level 2. So 15 minute, let's make this one. Actually, no. Let's make this 4 hour. Let's make this one day. Let's make this a week. Again, so I'm also particular about time frames because price is price indicative of time. So demand is demand at XYZ price, irrelevant to when it's been there. I do look at smaller time frames to see where price came to and out of, but that's because I'm looking at price, right? I look at the biggest time frame to get the biggest context of where the best opportunity is relative to the historical price of any given asset. So with that said, I look at where my supply is, and then I will see what option strike gives me the best risk reward depending on where my target is. And so for those of you guys that are OTA or just time frame familiar students, I usually give my expected time of arrival. So when I expect it to hit supply, contextually speaking, I I get the price and I give it 3 times out. So if it's an aggressive move and I expect this to rebound, let's say in a month, to let's say here at 1039, and last time it was here, so I'm gonna go ahead and zoom in. And then I refine it with the smaller time frames. Again, less than the time frames, I like to see the arrival in a given price, the shape of the arrival in a given price, and the way it came out, and how violently it came out, how long it took, but not necessarily the longevity of the time frame in, I think, the more traditional sense that people often tend to look at it, or I think people oftentimes correlate the 5 hour, the 5 minute, or what have you to position sizing and stuff like that. I don't do that. But regarding, the last time the price was there, if I would say a month, then I will look at 3 months out to give myself room to be ready, because you can always close an option contract early. And so let's say that's what I'm looking at. So then looking at the options chain, and if this took a month and I go 3 months out, and on a side note, I never take less than 3 months, because at least for me personally, like I said, I can always close it early and really have more room to be right. And if it goes against me, I can always also, like a stop loss, close it early and only lose a fraction of what you would, because it still has that extrinsic value. But if your account is not $25,000 or more for intraday trading options and doing more than 4 round trips, then I would be careful with that. That's just, for me, the way I look at it. But with that said, then I look based on my account and position size between current price or supply and demand. What is it that I am comfortable risking, and then how much of it, and what is my minimum risk reward based on the trade plan and example that I gave a couple of minutes ago. And I have a video just on the trade plan. And so if my range is from $6 to $11, then if you think about traditional trading, you're going to be stopped out or you're going to take profit, right? So if you're risking $100, you're going to get stopped out at 582. So with that said, everywhere in between, if that is the logic and that is the way you trade, then everywhere in between, because most people trade zero sum, stop loss or profit taker is eligible to be wrong or right. So then $100, let's say if the $9 call was $10, then you can buy 10 of those. And if your target is $11, then or let's say $12 for easy numbers, and you buy the $9 call, that's $2 times 10, and then you're controlling 100 shares, then you're essentially, and you're buying it for 20 cents, right? So because you're buying 100 shares, it would be, so then you're risking 20 cents to make $2 per options contract. Then you can, let's say, buy 5 of those at a approximately 10 to 1 risk reward. So let's just go over. I know that was very confusing and probably overwhelming. So let's just actually look at it from a practical standpoint. So I'm going to look at least at June because that's 94 days. And I'm going to look at all the strike prices. So at $11, it's 6 cents, right? So if my target is 12, then I'm essentially risking plus or minus commission, theoretically speaking, 5 cents to possibly make that entire dollar at 95 cents, right? So then at 5 cents or $5, you can buy 20 of those. And then if those 20 hit target, you make 95 cents. So let's just say $1 for easy numbers. You make $1 times 20, that's $2,000. And so then the probability of going in the money though is maybe less for you if you're looking at it that way. And then there's the other component of once it goes in the money and you get assigned, then that out of the money call, then you have to manage with the stop loss, but then you already captured that gain. So again, I understand that at this point it's probably tricky, but I just want to convey the message that contextually speaking, the way I look at supply and demand and asset class varies by opportunity of risk reward and capturing the biggest percentage move with the most likely to be right on top of supply and demand. So the first thing is, am I willing to control it? And price is king, contextually speaking, of the largest time frame. Second would be supply and demand and formation thereof. Third would be risk. And then after risk, I look at, based on that risk, what is the best way to capture that supply and demand of the asset class given the correlated markets, right? So ExxonMobil, Royal Dutch Shell, US Silver, crude oil, and out of that, what gives me the best risk reward. So the steps, even though it's already in supply and demand, are fundamentally different. And also maybe the way it's managed could be argued, but that is different. But in my opinion, it's so much more simple. So with that being said, guys, I don't want to make this video too long. I'll make a separate video on my YouTube channel or Capital Endeavor or Renata.com, wherever I settle in terms of formulating the education, explaining the detailed nitty-gritty steps thereafter. But contextually speaking and conceptually speaking, I hope that this video was helpful. Let me know. And, you know, I've heard a lot of people, and even my experience there, that oftentimes these big educational institutions tend to copy a lot of what I do. So I don't care a ton per se, but, you know, do you want to pay all this money to get information that is more often than not taken from talented people that are systemically suppressed for the gain of the institution? And that's just corporate politics in general and establishment in general, or go straight to the source of what kind of training style resonates the best with you and make it a community that is driven and focused on student success, trading for traders by traders, and then collectively learning and growing and adapting to different market conditions by people that are practicing what they preach, and building a community that is focused and centered on performance and gain and student success, or an establishment whose motives are questionable and continue to be questionable, and give back to the people that really love and care about you guys and this subject matter and education. So with that being said, guys, remember, nothing I say is a buy, sell, or hold recommendation. You can lose all or more of your capital trading the financial markets. My performance is not indicative of your performance, but I do feel like after 10 years of studying and training out in there, everyone you can imagine in my microcosmic universe of trading, and after all those trials and tribulations, I feel like I really created the most seamless, immersive, and intuitive, all-encompassing way to capture the best risk reward. And I continue to test different things on different market conditions because I really do care about this and the education, and I really do feel like it is the path of least resistance for your income and wealth goals because of liquidity, because of barrier to entry, and because of the possibility of compounding and exponential growth. And, you know, with great reward also comes great risk. I think the downside for the barrier to entry, even when I was at, this big institution with $20,000 education packages that I'm giving now that I paid for, that I'm sharing with you guys. Something that I would always say though is that this is not really an investment so much into us or into me or into the institution, but rather a commitment and an investment into yourself. And why I was so passionate about selling and teaching even at that price point was because for me that is how much more committed I was to myself because of it. I think inversely, whenever anyone can enter into a market condition or into something like this, it's easy to default and it's easy to over leverage and not have the dedication and commitment to yourself, and then blow up an account or what have you, and then feel like the institution, the person, or whatever is responsible because of the low barrier to entry. With that comes people with maybe false expectations. So I do believe in a happy medium, and I really hope you guys find this helpful. Let me know in the comments, or let me know just wherever you see this. And with that being said, again, my name is Ruben Dante. I do have a YouTube channel named Ruben Landon Dante, and then a website right now that I think my trading website will be www.capitalendeavor.com, with a lot of your favorite instructors, very likely than not. If not, it might be rubendante.com, which I am very into how you do one thing is how you do everything, and into metaphysical ascension and stuff like that. And so that one is more of a mixed bag of all encompassing personal development, spiritual developments, and trading. So I just want to set proper expectations that if you do go to that website, you might see things that you normally wouldn't see in a trading and education website. But it's who I am. It's what I love. Therefore, I will make a dedicated page, which I already have at Capital Endeavor. But as I continue to work and develop with different instructors and different people and collaborate, there might be a merger. And if so, then it will be temporarily held at rubendante.com, as that is me, until the new education name or what have you gets established. So with that being said, guys, love and light. Thank you so much for watching, and I will see you guys next time.